This is Nightly Business Report with Tyler Matheson and Sue Herrera.
What you see is what you get. The Federal Reserve says the economy won't grow much over the next few years, so what should you do with your money?
Dodging the rules, the EPA accuses Volkswagen of evading some regulations, and it could cost the automaker billions.
Corporate checkup, the next big challenge for stocks, is fast approaching. All that and more tonight on Nightly Business Report for Friday, September 18th.
And good evening, everyone. A Fed-fueled fall. Stocks started the day low and ended even lower as investors from Asia to Europe and here in the U.S. focused on the health of the global economy. The concern was sparked by comments from the Federal Reserve yesterday when it decided not to raise interest rates, in part because of a slowdown in China and heightened volatility around the world. The Dow Jones Industrial Average fell 290 points to 16,384. The Nasdaq dropped 66, the S&P 500 sank 32. For the week, the Dow and the S&P closed lower. The Nasdaq was higher, posting its first back-to-back weekly gains since May. But there was something else that the Federal Reserve said yesterday that could be cause for concern over the longer term. Steve Leisman explains.
When it comes to the economy over the next several years, what you see is what you get as far as the Federal Reserve is concerned. The unemployment rate, it's 5.1% now, and the Fed's latest forecast is it will only fall ever so slightly to 4.8% and stay there through 2018. Inflation? The Fed has been aiming for and missing a 2% target for several years. It's going to miss it for several more. The latest forecast doesn't see 2% inflation until 2018. The big news yesterday? The Fed isn't even sure of that. It held off on raising rates because of concerns that weak overseas growth could drag down the U.S. economy and inflation.
We've long expected, as most analysts have, to see some slowing in Chinese growth over time as they rebalance their economy. And they've planned that, and I think there are no surprises there. The question is whether or not there might be a risk of a more abrupt slowdown than most analysts expect.
How about the Fed's growth forecast? Gross domestic product, which has been a disappointing 2% since the end of the Great Recession, will remain, the Fed says, an unremarkable 2% through 2018. Gone are the days when the Fed forecast acceleration in growth that approached 4%. Still, Yellen said that if it were just focused on the U.S. economic data, it's good enough for the Fed to have raised rates already.
The U.S. economy is reasonably healthy. The job market is good. Overall consumption should be good. The problem is the remaining part of the economy, capital spending and net exports, that remaining 25% rather, is going to look horrible.
It's worth remembering, as lackluster as the U.S. numbers may be, they're still better than Japan and Europe. For Nightly Business Report, I'm Steve Leisman.
So with such lackluster predictions for growth from the Fed, how can you make money on your investments? Charlie Bobrinskoy is vice chairman and the head of the investment group at Ariel Investments, and he joins us with his thoughts. Charlie, welcome back. Good to have you with us.
Hi, Tyler.
Slow growth, terrific. Slow growth, 2%. Inflation, 2% or less. Interest rates relatively modestly low between now and 2018. That feels like a pretty good recipe long-term for stock investing.
Well, first of all, these are all predictions, and I guess I'm slightly annoyed that the Fed is falling into the trap of thinking that they can be precise about these expectations for the future. We're seeing in our companies reasonably good growth. Not great, but reasonably good. Unemployment is low. Interest rates are ridiculously low. And so we were hoping, frankly, that they would start the process that is inevitable of getting interest rates back to where they should be. But the Fed signaled to the whole world that they're more worried about the economy. And so everybody's worried that they see something we don't see. And so they took the market down pretty dramatically.
And at that point, then, when the market starts to behave in such a volatile fashion, Charlie, what are you doing for your investors? Are you adding to stocks that you see as longer-term values in an environment where we are going to see slow growth?
Yes, we actually are. And the other part of this problem is what it did was it made people get nervous again. And it made people move into safer stocks with higher yields, stocks that behave like bonds, REITs and MLPs and utilities that have a dividend yield. So everybody moved into those stocks, which frankly we think are overpriced. And what got hurt were the more cyclical names that are dependent on the economy. They'd already been down, but then they got cheaper today. So what we did was what we're recommending that others do, and that's buying the stuff that's beaten down and selling the very expensive yield stocks.
Let me come back to my earlier question, if you don't mind, Charlie. Over the next 3 years, now I don't care about what they did yesterday or didn't do. Over the next 3 years, is the environment going to be good for equities, not so good for equities? And will it be better for equities than for bonds?
That last question is the one I'm the most confident in answering, and that the stocks will do better than bonds. Bonds are historically overpriced. Interest rates have really never been this low in 200 years. You are getting nothing on your bonds. In fact, we think you're going to get a negative return after inflation. Stock dividends are going to grow. Stocks are a better place to be than bonds. Now, it's hard to make short-term predictions, but I think 3 or 4 years from now, we will get decent returns, high single digits, low double digits in stocks.
All right. Charlie, thank you very much. We appreciate it. Have a great weekend. Charlie Bobrinskoy with Ariel Investments.
An index of leading economic indicators inched up in August, helped by a stronger housing market. The Conference Board's index, which measures the outlook for the next 3 to 6 months, rose 0.1%, matching expectations. Some economists say the report suggests economic growth will remain moderate into the new year.
Americans are wealthier than ever. This according to new data from the Federal Reserve. Household net worth rose, this is in the second quarter, to more than $85 trillion. That's a record level. The reason for the rise includes higher home values and, in the spring, record high stock prices. Rising household wealth can make consumers feel better and, in turn, spend more. And it's that consumer spending that accounts for nearly 2/3 of American economic activity.
Barclays became the latest bank to cut its outlook for earnings. But this bank didn't just trim its forecast. In a note published after the Fed decision yesterday, it said it expects 0 earnings growth for 2015 for the S&P 500. The bank cited weakness in emerging markets and a strong U.S. dollar. It also cut its outlook for the tech sector.
And earnings are the next big hurdle for the stock market. The quarter ends in just a couple of weeks, and as Bob Pisani reports from the New York Stock Exchange, there's growing concern over what companies will report, especially on revenue growth.
Now that the Fed has made its decision, for better or worse, it's time to turn to what really matters, corporate earnings. And those earnings need some help, real help. The second half of the year was supposed to see an improvement over the first half's flat earnings growth, but it's not happening. Earnings are expected to be down over 4% compared to the same period last year, and revenues will be down almost 3% as well. Now, a lot of this disappointment is due to energy stocks, where earnings are expected to be down a stunning 65%. I'm not kidding, 65%. Now, besides energy, there's a broader problem. What we need, I've been saying this for over a year, it's not more cost cutting to hit the bottom line. What we need is more revenue growth, top line growth, and we're just not getting it. For the third quarter, the street is pinning a lot of its hopes for earnings and revenue growth on just a few sectors. Consumer discretionary expected to be up about 11%, financials, earnings expected to be up about 8%, healthcare up about 7%. Now, consumer discretionary is in pretty good shape. That's housing and autos. They're doing well. The retailer is a little bit more problematic. However, financials, banks, this is a problem. Now that the Fed is not acting to raise rates, there will be less upward pressure on U.S. interest rates, and that would have been a benefit to banks. That's not going to be there now. This is especially true of regional banks, and that's why a lot of the big names like Synovus and KeyCorp were all down 3 or 4% today and down yesterday as well. Now, we'll get some more insight next week when several big consumer names report earnings. Homebuilder Lennar, for example, as well as AutoZone and Nike. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
And still ahead, how new, more secure credit cards may cut one type of fraud, but potentially increase another. The Environmental Protection Agency is accusing Volkswagen of trying to dodge emission standards by making it look like nearly 500,000 of its diesel cars met federal standards, when in fact they did not. And now the automaker is facing a potentially hefty fine. Phil LeBeau has been following the story and joins us now. Phil, the EPA is alleging that Volkswagen rigged those cars so they could pass the clean air tests. How do they allege that they did that?
These vehicles had what's called a defeat device as part of the software in the vehicle, which, unless you're looking for it, you're not going to see it. It allows a vehicle to pass emission tests, but otherwise it will not have to meet those standards as it's going about driving around on the roads. And as a result, what you're looking at is a situation where the EPA says Volkswagen has 482,000 vehicles basically that were rigged to pass clean air tests, and in fact, they did not meet those emission standards. By the way, the EPA says that Volkswagen has essentially admitted to this happening. We will probably see some type of a recall remedy announced in the relatively short term because they're going to have to fix these vehicles.
So fundamentally, what I hear you saying here is that they tricked the system so that they could beat the test, but in real-world use, they were not going to meet the standard that they said. How big a penalty could the automaker be facing, and what, if anything, has Volkswagen said on the record about this?
Volkswagen is saying that it's cooperating with the EPA in this investigation, and ultimately, if there is a recall, it has to be issued by the automaker, so Volkswagen would announce that recall. The EPA fine is $37,500 per vehicle. That's the potential maximum fine. You add that up or you multiply that by 482,000, you get a potential fine of $18 billion. But let's be clear here, Tyler. Most likely you're looking at a fine that is going to be far, far lower than that. Nobody is suggesting that Volkswagen is going to pay a fine of that much. We're looking at vehicles, by the way, between 2009 and 2015, your most popular models manufactured by Volkswagen that are sold here in the U.S., the Golf, the Passat, all diesel models, the Beetle, Audi A3 is another one of the models involved.
So as we look at those models that are affected, you mentioned there's no recall yet. Can people keep driving those cars?
They can. They can continue driving them, and that eventually there will be some type of a remedy where they'll have to bring it into the dealership, and then those vehicles will then be made compliant with all the clean air standards that they were supposed to be compliant with when they were manufactured.
Thanks a million, Phil. As always, Phil LeBeau in Chicago.
You bet.
Well, we all know credit card fraud is a big problem in this country, so in 2 weeks, the U.S. will become the last of the G20 nations to adopt chip-enabled debit and credit cards as the national standard. And while the cards may reduce one type of fraud, they could actually increase another. And though card issuers and retailers are on board with the change, Mary Thompson tells us that non-bank ATMs may remain a prime target for criminals.
You may have yours, a chip-embedded credit or debit card. The chip's technology is seen eliminating the chance a counterfeit card can be used in a transaction, provided both the retailer and card issuer are chip-enabled. So while experts see these cards making a big dent in the 37% of fraud committed with fake cards, they expect criminals to turn their attention to other schemes.
These are organized crime rings behind all of these attacks, and they are not going to sit back and take a hit to their P&L. They're going to shift their tactics.
Their focus will become online fraud or web or digital transactions where a chip's technology is worthless. As a result, the financial research firm, the 8 Group, sees card-not-present fraud more than doubling in the 5 years ending in 2018. Though network operator Visa believes improved technology at online retailers will limit this increase. Driving the move to chip-enabled cards, an October 1st deadline, shifting the liability for in-store fraudulent purchases to the retailer from the card issuer, provided the retailer has systems in place to read that chip-enabled card.
And then a year from October, the liability for any bad transactions made with a chip-enabled card at an ATM will shift from the issuer to the ATM operator.
Ahead of this, criminals seen upping their efforts to skim at these machines or accessing accounts through data stolen from mag stripes on the back or cameras that read your PIN numbers. A chip-enabled card can cut this fraud, but upgrading ATMs to read them is pricey. Estimates range from $600 to $2,000 per ATM. It's an expense banks can bear, but One 8 Group's Julie Conroy says could pressure the independent operators running 2 out of every 3 ATMs.
I think we will see some higher ATM fees. I think we will see some of these ATMs just go away. So they're going to do a cost-benefit analysis on those little ATMs stuck in the corner of a basement of a hotel and decide it's just not worth the cost to upgrade those.
So the move to keep criminals from getting your cash could end up limiting the number of places where you can get your money. For Nightly Business Report, I'm Mary Thompson.
Shares of J.P. Morgan slip on a revenue warning, and that's where we begin tonight's market focus. At an investor conference today, J.P. Morgan CEO Jamie Dimon said trading revenue is down like its competitors. This quarter, Dimon didn't give a percentage, but over the past 2 days at the conference, both Bank of America and Citigroup have said their revenue is down about 5% this quarter. Shares fell almost 3% to $60.94. Johnson Controls says it will cut as many as 3,000 jobs over the next 2 years. That move comes as the company hopes to save $250 million a year in costs. Shares fell more than 2% to $40.50. Freeport-McMoRan has filed to sell another $1 billion worth of its shares. It comes after the company just finished a similar stock sale. The news pressured shares since stock sales make existing shareholders' stakes less valuable. The stock slid almost 10% to $10.88.
And investors got a chance to react to news that La Quinta lowered its 2015 guidance for revenue per available room. The hotel operator also announced that its president and chief executive has stepped down. Shares of La Quinta off 15% today to $16.05. Rockwell Collins also disappointed with its outlook. The firm says its revenue won't meet estimates since its avionic, electronics, and communications business is experiencing weak market conditions. The stock was off nearly 2% today to $83.68. Coca-Cola says it was notified by the IRS that it owes more than $3 billion in back taxes for the years 2007 to 09, but the beverage company disagrees with the claims and plans to work to resolve the dispute. The Dow component was 1% lower on this heavy down day. It finished at 38.98.
And now to our market monitor, who likes stocks with yields higher than the U.S. Treasuries right now. He is Eric Ristebin, Chief Investment Strategist at Russell Investments. Last time he was on in February, he recommended the following stocks: Target, which is down a fraction; Southwest Airlines, which is down 10%, and Proofpoint is up 8%. Eric, welcome. Nice to have you back with us.
Good to be here.
Do you still like most of those stocks, or all of them for that matter?
Yeah, we still own all of them. We still really like Target. It's one of the stocks we think is going to benefit thematically from an improving economy. We're just not buying that China is going to send us into the economic abyss. We think the U.S. is going to continue to grow, and companies exposed to growth are going to do well.
So let's talk about your first pick, and that is Target. You like its dividend yield, almost 3%, and you like big blue chips generally. So tell us about Target.
Well, Target, the dividend yield, it's important to think about this. It's above the market. The average dividend yield's closer to 2 than 3. So it's above the market, but it's not so high as to get the interest of yield specifically oriented investors. You get into really the highest yield stocks, they're a little bit pricey. So we think the yield offers a good basis for return. Plus the consumer is employed and they're spending money. We think Target will benefit from that and their earnings will move forward.
You also like Wells Fargo. In the face of a stronger economy, they may lend more. But a lot of these banks are out with statements today saying that they may have to cut costs because they were expecting interest rates to be higher, and interest rates aren't going higher right now. So why do you still like Wells?
Well, we're an investment firm. Our time horizon's longer than a couple of months, and what we think the Fed has simply done is they've delayed maybe by 3 months a move that they're going to make inevitably, and that we think the pressure on interest rates is up. The economy is improving. Car loans are up. Consumer loans are up. Even at modestly lower rates, we still think banks are a good buy, and they got a whole lot cheaper today.
And you like Raytheon. I guess you're betting there that defense spending will continue to be pretty strong.
Yeah, government spending in general, but defense spending in particular. You're actually seeing for the first time in a long time, government spending is now a tailwind for the U.S. economy. We see no reason that is going to abate. And we think Raytheon is well positioned and nice valuation at about 15 times PE. I think you're going to see them actually benefit a great deal from an improving economy and government spending.
And very quickly, you said you think that the Fed's going to delay just by a couple months. So that would put you on the record for a rate hike in December?
In December, absolutely.
All right, Eric, thanks so much. Have a great weekend. Eric Ristabin with Russell Investments.
Well, Greece, believe it or not, back on the minds of investors. We missed Greece, didn't we? The debt-saddled country is holding elections this weekend to decide who will become the next prime minister. And the results could have big implications, not just politically, but also economically, as Greece struggles to get back on its feet. Julia Chatterley reports from Athens.
A lot of influential people I've spoken to have said to me they actually hope that Alexis Tsipras and the Syriza party win this election. Why? Because if he's in power, if he forms a coalition government, he will have to stick to the bailout plan. There's no choice for this economy. The capital controls are a noose around the government's neck. If in fact he's beaten and is in opposition, then he could revert to type, become anti-euro, anti-bailout, and actually cause far greater problems at that point. It's an interesting take. A point I would finally make is that what we've seen from these polls is that they've consistently underestimated the support for Alexis Tsipras, and just on that basis alone, it seems likely that Alexis Tsipras could win through once again when the Greeks vote on Sunday. For now, we wait and see what his final rally here tonight looks like, and this is going to give you a real sense of just whether or not the Greek people are willing to give Alexis Tsipras and the Syriza party a second chance. For Nightly Business Report, I'm Julia Chatterley in Athens.
Coming up, why there's growing demand for one very unusual part of the sharing economy.
All right, here's a look at what to watch for next week. Dow component Nike will report its quarterly results. The Commerce Department will release its final reading of the gross domestic product for the second quarter on Friday. That is the broadest measure of the economic activity of the U.S. And Janet Yellen speaks along with a handful of other Fed officials. So buckle your safety belts. That's what to watch next week.
An update now on a story we followed over the past year and a victory for farm workers. A California judge ruling today that Garawan Farming, one of the nation's largest fruit growers, committed unfair labor practices. This as the farm tried to block the United Farm Workers Union from representing workers there.
If you've ever used ride-hailing services like Uber or Lyft, you may be familiar with surge pricing during peak hours. Well, Uber's new study aims to justify that practice. While customers may think it's greedy to hike prices when there's high demand for rides, the company says it's necessary. According to Uber, this is because it offers an incentive for drivers, ensuring there are enough of them to go around so customers can get a ride within minutes.
Uber is part of the so-called sharing economy that allows people to rent out or share just about anything from a home to a dress. And now you can also rent chickens. Yes, chickens. Believe it or not, there's growing demand for this unusual business. Morgan Brennan in Nanuet, New York, has our story on the real value of a cluck.
Farm fresh eggs in your backyard from chickens that are rented. Several startups have been hatched that lease out hens and all of the necessary supplies in what's perhaps the quirkiest addition to the share economy.
We are an affiliate farm. We raise chickens for our customers to rent for a 4 to 6 month rental over the spring and summer, and then we'll come pick them up so you don't have to keep them over the fall and winter.
Kay Whitmer owns a farm in Liverpool, Pennsylvania, an affiliate of 2-year-old startup RentTheChicken.com.
Usually we make more than one delivery in a day. The majority of our customers are very interested in knowing where their food comes from.
Rentals fill that yard-to-table desire, but without the hassle of an upfront investment or a long time commitment, since it can take 6 months for a young bird to begin laying. For $400, a customer gets 2 hens already laying eggs daily, a coop, and 100 pounds of feed, enough to last for the 4-month period.
And so if I wanted to hang on to these chickens for 4 months, it's $400, and that includes the price of the feed and the coop, and obviously the chickens and their eggs.
Rent the Chicken works with farmers like Whitmer to pair renters with birds. In return, those farmers pay affiliate fees to the home office. Company co-founder Jen Tompkins says by the 2016 rental season, she'll have signed contracts with 20 local affiliate locations, up from just 12 this year. And Rent the Chicken isn't the only company cracking open this concept. Maryland-based Rent a Coop operates in 8 states, charging $180 for a 1-month coop. Michigan-based rentachicken.net has clients in 9 states who rent 2 hens for up to $450 for 6 months. Bird flu has been a boon for business as well, as egg prices have climbed to record levels after a devastating outbreak wiped out more than 10% of U.S. production. These companies say demand for backyard flocks has jumped. No small feat given the price renters ultimately pay. At $400 for 4 months, that breaks down to $1.79 per egg, a total of $21 per dozen. A sum at least 3 times higher than the priciest organic eggs in the store. But a premium a growing number are willing to pay, just to know where breakfast came from. For Nightly Business Report, I'm Morgan Brennan in Nanuet, New York.
There's
They
so
might
many
balk at
places we
that.
can go.
The puns just keep coming here.
But we won't. We will not digress because that is Nightly Business Report for tonight. Thanks for joining us. I'm Sue Herrera.
Have a great weekend, everybody. I'm Tyler Mathisen. We'll see you back here Monday.